I'm Josh Duvall, certified financial planner, chartered tax consultant from Duvall Wealth and Tax Planning. Just wanted to bring you a quick video to talk a little bit about the interest rate cut announcement that the Fed proposed last week. They're looking to cut interest rates from a high of 5.5% all the way down to the range of 4.75 to 5%. So it's 50 basis points or half of 1% cut. And the reason they're doing that is for a few reasons. Number one, it's the first time we've had an interest rate cut since 2020. Obviously, we had COVID, we had inflation. They raised interest rates as a result of trying to slow down inflation in the economy. But when you raise interest rates, you make the cost of borrowing capital, whether it's for home mortgages or credit card or small business lending, it creates higher costs for businesses and individuals. So the result of that can be a little bit of a slowdown in hiring, in business activity, business growth, in sales, earnings, as well as in consumer spending. So there's always a balance between dealing with inflation. The Federal Reserve's goal with inflation, they say, is a 2% annual inflation rate. We've been much higher than that. We had inflation, 9+%. In some areas of the economy, we've seen inflation, 50%. We know that at the grocery store. You can see the cost of things that have gone through the roof. So they raised interest rates to try and get a handle on that. Now that they feel more confident about where the economy is related to inflation, they're deciding to bring interest rates down. The question is, what does that really mean for you? Well, it's going to have impacts on a couple areas. These impacts are not going to be immediate, but they will start to happen over time. And if the Federal Reserve decides to continue decreasing interest rates, we're going to see these effects happen in a greater measure. One of them is that the rates that banks and the savings institutions are willing to give to customers is going to start to decrease. The other area where this is going to have an effect is going to be in mortgages. So we've already started to see some pressure come off of the mortgage interest rates over last year. We're going to see more pressure come off of interest rates. The concern about that is that interest rate sensitivity is connected to prices, and we already have a home shortage in the United States. Our housing starts and our available new housing starts, as well as available homes for sale. We've been in a shortage for years. Really happened as a result of the financial collapse of 2008, and about 50% of home buyers went out of business. We've never recovered that inventory. And so the concern on the home buying side is for those of you that purchased homes at maybe a 7% rate or something like that, within the next 1 to 2 years, you might see the rate come down enough that it would make sense to refinance. And there's a whole conversation about refinancing your loan, but that could save you significant interest. It could reduce your monthly payment. You could pull cash out. The other thing that's going to happen, though, is if interest rates come down, new home buyers, so people who are not who currently don't own homes now, are going to be looking to get into the market because the cost of borrowing money is going to be cheaper. And the issue is we already have a shortage of homes. So we're going to see home prices, obviously barring a significant financial collapse, we're going to see home prices continue to rise as a result of more buyers getting into the market because of the cheaper cost of capital. On the stock market side, how could this affect you? Well, it might look at boosting up the stock market related to where people are going to start putting capital and looking for return. There's a number of investors that would stay on the sidelines. They'd keep their money at a bank or in a money market if they're earning 5%. Now that those rates are likely to come down, right? The Federal Reserve raises interest rates. That means banks are going to, Federal Reserve cuts interest rates. Banks are going to follow suit and cut the interest that they're willing to pay. Investors are going to be looking to go elsewhere with their capital in order to find returns. So that could bode well for the stock market. Obviously, it's one of a million variables that make up stock market activity. But these are the types of things that you should be thinking about. So what that might mean for you personally is looking at your portfolio allocation. As we start to see the high interest on high yield savings, CDs, and money markets come down, that might lead to a portfolio allocation change where you're willing to take a little bit more risk in order to get a return, since the banks aren't going to be providing that. The other area that you might want to be looking at is related to mortgages, whether it's potential home refinancing, or if you're someone who has yet to buy a home and are thinking, hey, interest rates coming down might be a good opportunity to jump in. Those are the types of decisions that you should be focused on. So we'll see what happens over the next 12, 18, 24 months with interest rates. But the idea is that we're starting to now go in the other direction after years of raising rates and holding steady. We're now cutting. The goal is to help stimulate the economy, stimulate business growth, and of course that has other effects that we just talked about. So if you have any questions about how these changes affect your personal finances, please feel free to reach out. You can shoot me an email, josh@duvallplanning.com, or go to the website and book an introductory 15-minute call, or for clients, a 45-minute Zoom meeting. You can do that at duvallplanning.com. Thank you so much. Hope you have a great day. Bye-bye.